In this video, we're going to have a look at the difference between a bull pennant and a bear pennant. Now, reminder, in the previous lesson, you just learned about the bull flag and bear flags, and this is a very similar pattern with just one or two small differences. So if you have a look at the slide, this is a textbook perfect example. This is your bull pennant. Price moves strongly towards the upside, begins to consolidate, creating higher lows and lower highs, so getting into a tighter and tighter formation, which ultimately breaks out in line with the previous move. So this would be your pole formation over here. Here's the pennant, price consolidates, gets tighter and tighter in that triangle, and ultimately leaves in the same direction as the pole that you previously had. The same is true on the bearish side. Price moves down, creates higher lows and lower highs. There you can see higher lows and lower highs, consolidates into a tight triangle and breaks towards the downside. The measured move works in exactly the same way as with the bull flag and bear flag. You simply take the pole, copy and paste that from the breakout point, and that will give you the measured move of this trade. So let's have a look at some real life examples on the charts. If we have a look over here, this is an example back from Shiba Inu on the 4-hour time frame, and you can see the flagpole formation. Price moves up very aggressively. It then comes down, bounces from that level, creating a higher low, lower high, higher low, lower high. And this is round about when you should start to identify that there is actually a bull pennant in play, and you start to look to time your entry. So as price starts to grind against this resistance over here, this would be round about when I would start to look to gain an entry into this trade. Your stop loss would simply go below those previous lows, ultimately meaning that if price breaks down this trend line, then you would stop out of that position. In this instance, we had a 4.2 to 1 risk to reward ratio trade at play, and it led to a massive 103.88% upside move and actually superseded way above that target. But the pattern played out exact. You have your measured move, and there we go. Target was met. You can move on to the next one. So let's have a look at what it looks like when you see a bear pennant. Moving on to the next one over here. This is Bitcoin on a lower time frame, a 15-minute chart. Remember, these patterns repeat no matter which time frame you're looking on. They are still relevant. So price consolidates over here, leads to a strong breakdown, bounces, creating a lower high, higher low, and this is round about when you start to identify the pattern, looking for your trigger plan, and price breaks down. So if you have a look at the percentage move towards the downside over here, you can see it's only a 2.67% move, which might seem small, but remember, the ratios are what are more important. What do I mean by the ratios? I mean, if you look at the ratio between your risk and your reward, you have a 3.02 to 1 risk to reward ratio, which based on what you learned in the very first lesson, which is risk management, you'll know this is still a very valid trade setup, and you should take it every single day of the week. So in the next video, I'm going to be taking you through one of my favorite chart patterns, which is the ascending and descending triangles. These have a super high hit rate and work most of the time, and I made a lot of money off them. So I'll see you all in the next video. Cheers for now.